If you are considering buying a restaurant in 2026, a financing change that took effect on March 1st could significantly impact your transaction. The U.S. Small Business Administration has revised eligibility requirements for its loan guarantee programs, altering who can qualify for SBA-backed financing. For restaurant buyers and sellers, this change directly affects ownership structure, partner eligibility, and deal strategy. Most notably, lawful permanent residents, commonly known as green card holders, are no longer eligible to own any portion of a business that receives SBA financing. At We Sell Restaurants, we believe financing clarity must come before emotional commitment. Below is a clear explanation of what changed, why it matters, and what options remain available. Key takeaway. As of March 1st, 2026, a business applying for SBA-backed financing must be 100% owned by U.S. citizens or U.S. nationals whose principal residence is in the United States or its territories. Permanent residency alone no longer qualifies. What changed historically? SBA rules allowed lawful permanent residents to own businesses that received SBA loans, provided citizenship and residency requirements were met overall. Prior guidance required that at least 51% of a business be owned by U.S. citizens or lawful permanent residents. Effective March 1st, 2026, through SBA Policy Notice 5000-876441, two significant changes took effect. 100% U.S. citizen or U.S. national ownership is now required. Any ownership interest by a green card holder disqualifies the business from SBA financing. Even a 1% ownership stake by a non-citizen or green card holder makes the entire loan ineligible for SBA backing. These rules apply across the SBA's primary lending programs, including loans, widely used for restaurant acquisitions, working capital, and equipment. 504 loans, commonly used for real estate purchases, and long-term fixed assets. Why this matters in restaurant transactions. SBA loans are central to restaurant financing because they offer lower down payments, often 10 to 20%, longer repayment terms, competitive interest rates tied to prime, the ability to finance goodwill, equipment, working capital, and real estate in one structure. For many first-time restaurant buyers, SBA financing represents the most realistic path to ownership. Without access to SBA products, buyers often need to bring more cash to closing or accept less favorable loan terms that reduce future cash flow. This shift also affects sellers. If a meaningful portion of the buyer pool in your market includes green card holders or non-citizens, the number of buyers able to secure SBA financing may decrease. That can influence deal timing and structure. How lenders are responding. Banks and credit unions that offer SBA loans have implemented stricter ownership verification during underwriting. Citizenship status must now be documented for every direct and indirect owner. Common documentation requested includes U.S. passport or birth certificate, certificate of naturalization, operating agreements or corporate filings reflecting ownership percentages, signed affidavits confirming citizenship status. Deal timing has also become critical. According to lenders, applications that received an SBA loan number before March 1st may still be processed under prior rules. After that date, all applications must comply with the updated ownership requirements. Alternative financing options. The updated policy does not prevent green card holders or non-citizens from owning or operating a business in the United States. It restricts only access to SBA guarantees. Buyers who cannot qualify for SBA financing still have options. Conventional commercial loans. Some banks and credit unions offer non-SBA commercial loans. These typically require stronger credit profiles, higher equity contributions, and may carry shorter terms. Seller financing. In many restaurant transactions, sellers carry a portion of the purchase price through a promissory note. This can reduce the amount a buyer must finance through a lender. Seller financing often represents 10 to 30% of the purchase price, though structures vary. Private investors or U.S. citizen partners. In certain cases, A U.S. citizen partner may hold 100% ownership to meet SBA requirements. This must reflect genuine ownership and withstand lender scrutiny. Legal guidance is essential before pursuing this structure. Private equity or family office capital. For larger acquisitions, institutional capital may be available, though this is less common for small independent restaurants. Buyers on temporary visas such as H-1B or E-2 must evaluate financing strategies carefully. In addition, citizenship requirements may impact liquor licensing in some states, requiring a U.S. citizen or lawful resident to hold the license. Practical steps for buyers. Confirm financing eligibility before submitting an offer. Discuss ownership structure with your certified restaurant broker. Gather documentation early to avoid underwriting delays. Compare SBA, conventional, and seller-assisted structures side by side. Practical steps for sellers. Ask about buyer financing strategy early. Be prepared to consider seller financing if SBA is unavailable. Manage timelines carefully if a transaction is already in motion. What has not changed? The updated SBA rule does not restrict ownership rights. Non-citizens and green card holders may still legally buy, own, and operate restaurants in the United States. The policy affects financing eligibility, not business ownership itself. It also does not restrict access to conventional loans or private capital that do not rely on SBA guarantees. Frequently asked questions. I have a green card. Can I still buy a restaurant? Yes. You can legally own and operate a restaurant. However, if you hold any ownership interest, that business will not qualify for SBA 7A or 504 financing. Alternative financing will be required. What if I own only a small percentage? Even a 1% ownership stake by a non-citizen or green card holder disqualifies the entire SBA loan application. The rule requires 100% U.S. citizen or U.S. national ownership. My spouse is a U.S. citizen. Can they hold ownership to qualify? Potentially. If a U.S. citizen holds 100% genuine ownership, the entity may qualify. Lenders will closely review documentation to ensure the structure reflects true ownership. Legal and financial advice is strongly recommended. Does this apply to franchise purchases? Yes. SBA eligibility requirements apply to both independent restaurants and franchise acquisitions. What alternative financing is most common? Seller financing, combined with conventional commercial lending, is the most frequent alternative when SBA financing is unavailable. The bottom line, SBA financing has long been a cornerstone of restaurant acquisition strategy. As of March 1st, 2026, eligibility is limited to businesses fully owned by U.S. citizens or U.S. nationals, residing in the United States or its territories. Permanent residency alone no longer qualifies. For restaurant buyers, financing eligibility must now be addressed at the very beginning of the process. For sellers, understanding your buyer's financing profile early can protect deal momentum. We Sell Restaurants works with buyers and sellers nationwide to structure transactions that align with current lending requirements. This is for informational purposes only and does not constitute legal or financial advice. SBA policies may change. Always verify current requirements directly with an SBA-approved lender.